Okay, good afternoon, everyone. I'm Sanjeev Mohta from BNK Securities. On behalf of BNK, I welcome all of you to this session on real estate and allied sectors that we will be carrying out whole of this week. We are really pleased to have Mr. Girish Kousgi, Managing Director and CEO of Canfin Home, and I can see we have the Canfin Home senior management team as well with us. Thank you, Mr. Kousgi, and everyone for spending your valuable time.
Thank you.
And we also have Sanket Chheda, who heads our NBFC sector. So, sir, the way we'll do it is between the two of us, we'll kick off the question and answers.
Sure.
And then we also have quite a few participation from investors side, and we will open the floor after about maybe half an hour or so for Q&A. And what I request anybody who has a question can raise their hand, and we will kind of unmute you and ask the question. Or alternatively, you can post the question or send us the question and we'll ask those questions. That's how we'll do, sir.
Sure.
Okay, great. So maybe just to kick off mostly on a very macro point, which is Ukraine notwithstanding, and let's not it's very difficult to kind of make a judgment by anybody on this. But assuming things as business as usual, we had actually started we are at the beginning of a real estate cycle, and we were seeing evidence of that. Just wanted to hear your perspective. What are you seeing, and especially not just on the urban centers, what are you seeing on the the smaller towns as well? It'd be great to hear your perspective.
Sure. I think after COVID, the revival started from last October onwards. From last October onwards, I think market is quite robust, and not just Canfin, entire industry is seeing increased demand. But for Q1 of this year, because of second wave, I think only that quarter we had some impact. Otherwise, from Q3 of last year, to be specific, from October of last year till now, barring April and half month of May this year, I think it has been a great run for housing finance companies. And I feel that this is going to stay for another few years at least, if not more. So I expect this run to continue for another 5 years at least. And if you look at real estate is in the process of revival. And now we can see that happening across all segments, even in the real estate space and also in the home loan space, whether it is affordable, non-affordable, whether it is large cities, mid-sized cities or small towns. So we see that there is increased demand from across geography, across profiles for this is across products. And same thing is also true with the real estate, because the revival is very it started, of course, it's still in the process, but I think we are seeing very good demand from all segments, starting from affordable space projects to mid-size, high-end, and also premium. So premium, I think till about a month back or so, I think the demand was a little short of what it used to be at its peak earlier. But I think it's almost, I think overall, if I have to say, I think the demand is back more than 95% in the real estate space. And as far as home loan is concerned, across, I think demand is quite robust. It's close to 100%.
Right. And the way you're saying that, you think that this is a multi-year phenomenon. That comfort?
I'm not sure, whether it's multi-decade or not, but multi-year, so definitely yes. At least for next 5-6 years, we can see this run happening. Notwithstanding that there's going to be increase in interest rates, but I assume that I think this market has seen how they can build portfolio in an interest rate increasing scenario. And we don't expect rates to go up drastically in next at least 18 to 24 months time. And I think because we have seen peak of 12-13%, and now we are hovering around 7.5%. Even if you take a 5-6 year horizon, I think rates won't go beyond 250 or 300 bips. So I don't think so. There's too much of a concern from the interest rate point of view. Of course, I'm not touching inflation now. I know it's always contradicting, but I'm just saying purely from real estate and home loan business point of view. I think it's going to be pretty good because even today affordability is highest, property prices are at the lowest, demand is quite robust, economic activity is improving, notwithstanding what happens between Russia and Ukraine. Otherwise, I think market is pretty good, and it's going to be a dream run for housing finance companies.
Right. So let me move to the next part of this, which is more on the competitive intensity. And you said, housing finance, it'll be good for housing finance company. Currently, though, the banks also are quite active in this whole thing. And, we have seen banks' market share also is pretty strong. And given that the economy hasn't been that great and credit hasn't yet picked up, the banks have been pretty active in the housing finance space. So I'm just trying to understand, where do you see competition? Is it like banks are still limiting themselves to prime and the high ticket, or you are actually seeing banks across the board?
Yeah, I think after COVID, I think banks are not to their initial level of lending across all the products. I think corporate is. I think they have to cover some space in the corporate lending. SME and MSME have picked up drastically. Consumer also has picked up. I think the unsecured piece is still underpenetrated. But having said that, the kind of competition what we saw from all the banks, be it PSU, um, private banks, small banks, big banks, including SFBs. I think last year there was too much of competition in the space. That's more because of COVID. And now COVID is almost over and out. And we are seeing that from quarter four of this year, sorry, quarter four of last year, quarter four of last year, and the first 3 quarters of this year. For last 4 quarters, we are seeing that we are not being impacted by competition. There's going to be some impact, hardly that is it's very less. So we don't see stiff competition at all, especially this year. It started quarter four of last year. So last year, quarter one, quarter two, quarter three, we had stiff competition. And we had competition because of COVID. Obviously, economic activity was low, corporate lending was not taking off, and same thing was true with SME and MSME. And therefore, a lot of banks focused on consumer, within consumer secure, because that's the easiest way of growing book and also safely. Since there was a lockdown across for about almost few days, and it had its impact at least for 2 quarters, quarter one and quarter two, because we also had moratorium till August. So all the banks, they focused on mortgage, and within mortgage, because of lockdown, they focused on balance transfer,
Right.
because that's easy kill. And this had an impact of flight of book from HFCs and NBFCs to banks. And therefore we saw a lot of competition. We also got significant amount of book at that point in time. So to arrest that, we changed our pricing strategy. We dropped rates to retain our customers and to do incrementally whatever business we could try and do from market. This we saw in quarter one, in quarter two. From October we dropped rates. So quarter three for us impact because of competition was low, and in quarter four it was not there at all. Now after in April we increased rates, and if you see this financial year we have increased rate twice. So in spite of increasing rates twice, in last 4 quarters, last 3 quarters, we have done all-time ever business in the history of CAN. So quarter four of last year was all-time high at that point in time. Quarter two of this year was again all-time high. Quarter three of this year was again all-time high in terms of book growth, in terms of disbursements, right? So this year we are not seeing competition at all. And even if rate goes up, I think we have the wherewithal to try and build the book, because that's what we've been doing for last over 3 decades.
Right. And you're seeing the same phenomenon as you've seen in last couple of quarters continue even in this quarter?
Yes, absolutely. It's quite robust.
Right. Okay. So the other thing was, if you look at some of the competition that used to be like Divan or India Bulls, they kind of getting more, pretty much out, and now the industry getting more consolidated. Are you going to see you? What's your view? Would you see more benefits of that, both in terms of margins and ability to grow?
Yeah, I know. I think unfortunately, a couple of housing finance companies went bust,
Yeah,
and we all know why. What happened, why it happened, and how it happened. We know that.
yeah.
Yeah, definitely, yes, it has helped certain companies which could stay afloat. But I think the larger picture is uh, market is huge.
Hmm.
Market is really, really huge. And I think we are getting the benefit because of certain factors. One, economic activity is picking up, market is huge, affordability is at the highest, interest rate at the lowest, revival of real estate industry. I think there are many factors. Yeah, to some extent, probably a couple of HFCs, they had to shut shop. I think that also helped to a certain extent. But I think there are other factors which are actually supporting this industry to grow.
Sure. So you've been talking about almost like 18 to 20% growth. Been showing that also, and now I think last couple of quarters you've also been saying that now the dispersal, as you said, you've started losing. That what book you were losing now probably you're going to. That's not happening anymore with for balance transfers and stuff. So if I look at going forward growth, just trying to understand, where do you think this will come from? Higher ticket? Would your average ticket size actually be going up? I'm asking this question especially in the context that now your cost has actually become very, very competitive. You are probably, as low as HDFC, probably lower than LIC. So you can actually now afford to go up the curve, right? So I'm just trying to understand where would this growth come from?
Actually, we are the best in the cost. I think we are one of the
Right.
industry best. Of course, the
Yeah,
gap is not much, but we are better by 20 bips or so.
that's right. Yeah.
Our focus would still remain on affordable. Our ticket size, which used to be about 18 lakhs, now it is 21 lakhs. So it might inch up, but that will be very marginal. Our focus is on affordable. And only in salaried space, we are focusing to so slightly higher ticket size, but that won't have too much of impact on the ticket size. So our ticket size would be in the range of 21, 21.5, 22 lakhs only. Our focus is not high ticket. Our focus is not high ticket. Only thing is, today we are far better in terms of competitiveness in pricing compared to a year back. I
Hmm.
think we have that edge. So, certain markets have opened up for us. And today we'll be able to source slightly better profiles in the salaried space. And that might probably help us to increase our ticket size. Otherwise, our focus is completely on affordable.
Right. And so, in terms of builder segment, you're hardly there, and you see yourself getting into that segment also. Now that is also coming back, right?
Yeah, actually, we were not there in that space at all. We had very
Yeah,
less portfolio, and actually, we run down the book. I
yeah,
think today we have less than a crore, out of a total book of about 26,000 and odd.
yeah.
So we were not there at all, but we do plan to get into it at the right time.
Hmm.
But however, at this point in time, whatever exposure we will take in next couple of years won't cross 0.5% of a portfolio.
Sure. And so, last question from my side on, I think I think you've been saying this in your discussions earlier also that the non-salaried side had been not growing because of COVID and so on. Are you, and there been some revival there. Are you seeing that go back to pre-COVID kind of level?
I think in 2 quarters from now, I think it will come back to 2 or 3 quarters, it will come back to pre-COVID level. We had a mix of 70 salaried and 30
Yeah.
self-employed. Now, incrementally, self-employed is about 26, 27%, down by about 3-4% compared to what it used to be before COVID.
Right.
It went down to as low as 12%. I think slowly it's picking up. With every passing quarter, this ratio, this mix is changing. Another 2-3 quarters, I think it should be back to 70 and 30.
Right. Great. Sanket, over to you.
Yeah. Hi, sir, and good afternoon to all of you. So, again, coming back to the cost leadership thing that we have had, and we never had this in past, which puts us in a very sweet spot in terms of maybe moving up the ladder or even going down the ladder, maybe doing 15, 17 lakhs or 12 to 15 lakhs ticket size, because all the other HFCs have a higher cost structure than us. So just as you highlighted to Sanjeev sir, that maybe we'll look to tab the Celerite in the higher ticket size segment. Will we also consider maybe moving down the ladder a bit, wherein whatever HFCs are operating would have a much higher cost of funds, and we being at much lower rate, we would be able to offer attractive rates and also acquire quality customers out there.
So today, if you look at the segments, I think it starts for us from 6 lakhs onwards. So between 6 lakhs to 10 lakhs, also we focus on that specifically because we have various requirements. So we are present in all the segments. For example, 6 to 10 lakhs, 10 to 15, 15 to 20, 20 to 30, and up to 50. I think more than 50 lakhs, we have about 3% in our portfolio. And now that might slightly go by another maybe 10 or 15. We might go to 3.15 or 3.2. Otherwise, our focus has maybe already there on the other side. So we are focusing on a lot of cases less than 10 lakhs as well. So I think nothing much value would be there in terms of portfolio increase. But yes, to a small extent, we might focus on salaried higher ticket, which might help us to better our portfolio from where we are and also to slightly increase the ticket size.
Sure, sir. And now on the cost of fund side, we talked about maybe we are on the verge of seeing an increasing rate cycle. So just wanted to understand, as far as the transmission is concerned, how the transmission is likely to happen. As far as my understanding goes, maybe the transmission on the loan side happens much quicker, but the impact on the liability side is would be spreaded over 3 4 quarters, because that gets reset at a particular time, and most of the borrowings, maybe NHB and CDs, are at a fixed rate, right? So how the transmission would happen, and will we see maybe some positive impact initially when the interest rate starts to move up and we pass the same on to loan side?
It's a continuous process. Actually, whatever rate we increased, let's say in first time was in April this year and second was in July. So we increased rate twice. So that benefit we will see in every quarter, but maximum we will see in fourth quarter. So this is one option. Number two option, suppose if the interest rate goes up, we can pass on that rate increase to all the customers in less than 15 days. So one is on a reset model, and second is, we can apply that to the entire portfolio if the interest rate goes up in the market. So we have both the options, and depending on the need, we would try and choose which option to exercise. Reset is a regular normal phenomena every year, but if rate goes up, we will definitely pass on that to all the customers. And the lag time is hardly 2 to 3 weeks time.
Okay, sir. And the fact with the rising interest rate is also that the economy has started to do well, or the other segments like corporates, MSE, SME, MSME also are doing good. Do you feel the intensity which has come down in FY22 will further come down as banks move back to their core businesses, which are relatively higher ROE businesses for them?
I think in another 3 to 4 quarters time, I think till such time, so we can see, because even now the bank's focus on mortgage is still there. It's more than what is required because unsecured within consumer has not picked up, and within secured small ticket has not really picked up, right? Because they are now probably focusing on prime and prime plus kind of profiles and products. So another 2 to 3 quarters, maybe max 4 quarters, I think we might have an edge because of that factor as well. But nevertheless, I think since the demand is quite robust and market is wide open, that trend would continue. And this will anyway add to that.
Sure, sir. And finally, coming to asset quality, last 1 decade, our NPA has not crossed 1%. Even after both the waves of COVID, our NPA is still below 1%. So, how do we see it going ahead? Particularly, wanted to ask how the restructured book is behaving and how much of incremental delinquencies we expect out of it, and will there be any write-backs? Because on provisions we are quite adequately provided. So as in when we see asset quality tailwinds, does that entail any sorts of write backs in the coming quarters? Sir, your voice is not coming.
Okay. Am I audible now?
Yeah, sir.
Okay. So 40 crores of restructured book has come down, which means customers have repaid the loans. So the book has come down by 40 crores already. I think last quarter this number was about 20 odd crores. Now, from out of the restructured pool, we expect about, I used to say 45 crores. Now, since the book has come down, maybe about 42, 43 crores, that would flow into APA eventually. At the same time, we also have planned to recover from the NPA pool. That will be about 50, 52 crores. So if you look at the net impact, it will be on the minus. So I think NPA is going to be quite stable for next few quarters.
Sure, sir. And will that entail any sorts of write-backs, smaller write-backs?
Definitely, see, on the restructured book, because we have provided 10%. So anything which moves to NPA, I have to provide additional 5%. But when I recover from the NPA pool, I can write back either 100% or 25%, depending on which bucket it is. So obviously, my write back is going to be marginally higher than what I'm going to provide. So even there, I'll be on the negative in terms of the provisioning write back. So
Sure, sir.
I will write back more than what I'm going to provide.
Sure, sir. And sir, on now the capital raise, where capital adequacy is very comfortable, and since we had not grown much before this FY22, the leverage has kept coming down. So uh, unless we continue the growth of say 20% for couple of years or more, we don't actually need to raise capital. But how we are thinking on that? Will we come for the capital raise anytime soon, or maybe we'll evaluate that at a later stage?
Yeah, as of now, I think it is not required, but we have planned to raise some capital in next 3 to 4 quarters because we've been saying this for last 2 years, and no, really there was no need to raise capital. But now we feel that we need to raise some capital in next 3 to 4 quarters. It will be a small amount, but we will raise capital. Looking at our capital adequacy, I think we are pretty comfortable. Even DR has been coming down, but still we will raise some capital.
Sure, sir. And lastly, on any conversation with rating agencies for any potential rating upgrade for us from AA plus that we have currently?
We are in touch with the rating agencies and they are reviewing. Because even earlier, I think AAA was not assigned due to a particular reason assigned to the parent. And now we understand that, parents rating has been upgraded. So we also have represented and, they are in the process of evaluating.
Sure, sir. I think those were the questions from me. Now we hand it over to anyone from client. If they have any questions, they can raise their hand.
Sure.
And
So I think Devansh has a question. Let me, I'm just sending an unmute. Devansh, I have unmuted you.
So just a couple of questions. So one is in case of, can you help us understand the how commercial paper interest rates will move? Because what we understand is at the time of the liquidity is high in the system, the spreads from the interest on advances are really high. But when there is tightening of liquidity or probably increase in interest rates, commercial paper interest rates they move up sharply. So if you can just comment on how this mix has evolved in last 3 to 5 years, and how do you think that will really behave going ahead? Also, is there any percentage mix where we want to restrict the mix? If at all, you can just throw some light on these 2, 3 questions.
Yeah. So when the interest rate goes up, even the CP rates will go up. But on a steady state, we have seen that CP rates would be much lower than the bank rates. So when we raise CP, it is not for funding; it's only used as a leveraging tool to manage our cost of funds. So even if the interest rate goes up, we would definitely have some kind of positive carry, through CP. So this trend would continue unless and until CP becomes very expensive. Then because today we are raising CP not for funding, it's only against backup against unutilized OD and CC and undrawn term loan limits, and we maintain liquidity close to a year's time. So if at all there is a situation where CP rates becomes very expensive, then we would not raise CP. We would manage through other source of funds. But that has never happened till now because always CP has been one of the lowest on a steady state. You might have one or 2 months, CP will become very expensive. Then we will not raise. Then again, it will settle down. It will come down. Then it will be much cheaper than the bank rates. And since we carry huge liquidity, and for cost leveraging purpose, we use CP. And we have internal limit of CP. So we work within those limits. As of now, the limit is about 4,500 crores.
Okay, so 4,500 crores. By that, we are almost at the peak utilization level for CP, if I'm not wrong, the numbers.
It's on a continuous because we take for 3 months, different tenures right up to 1 year. So yeah, you may say that at times intra quarter we might be at a high, end of the quarter will be low. So it keeps changing depending on the maturity dates.
Correct. And sir, what would be the cost of borrowing right now from CP? If let's say if I have to just look at December quarter.
CP will be on an average about 4.35, 4.36.
4.36. So okay. So our so just a second. If I look at just a second. Can you come again?
4.36.
Okay, 4.36. So that is basically 1.3% lower than the blended interest on borrowing, correct?
Bank borrowing or overall?
No, total blended interest borrowing on the
Yeah.
whole portfolio level.
Yes, correct.
Correct. Okay. And sir, in case of write-backs, for a fairly long time, we've been hearing from you that we'll start, invoking the securitization and recover the pool. But over here, the activity hasn't been much. So if you can just throw some light on how where exactly are we in that situation?
Actually, we started that from quarter 2 of this year, and we are reaping benefits every quarter. So basically, if you see in last few quarters, our NPA has come down. Our NPA for last quarter is 0.68. So for example, every quarter we add to NPA certain amount, and we recover certain amount. At least till now, the recovery is more than what I'm adding, and therefore my NPA is coming down. And it's on a continuous basis. For example, last quarter also we recovered. My recovery was more than what I added, and therefore my NPA came down from 0.71. So every quarter you will see this change, and NPA is coming down because my recovery is more than what we're going to add. And over a period of time, I mentioned this amount is about 50 odd crores.
Okay. Okay, sir. So as of now, so just one more question. Actually, regarding IPO, we mentioned, that we have been considering to raise fund, but I'm still not able to understand the logic when we are at our desired ROE profile and the kind of growth rate we have. Even after considering that, why are we considering raising funds? Is it the direction of credit rating companies, or what exactly is the thought process? Because our valuations in the market are still very cheap, and then even we'll be raising it at a cost which will be not really cost accretive. So just some thought process over there, if you can highlight what exactly.
So when COVID started, I think most of the HFCs and NBFCs raised capital. We didn't raise capital then because we were pretty comfortable on the capital adequacy. TR was quite high, and therefore what happened was, since we dropped rates last year, our PAT was little lower than what we had expected. So because of COVID, PAT took a beating. Anyway, now if you look at the year, it's about 7.5, 7.6. So if we'll raise some capital, we understand, we know the implication of all the ratios and stuff like that, but we also want to grow. So for us to grow, we need to raise some capital. And therefore we said that we're not going to raise the entire amount what is enabled at this point in time. We will try to phase it out, and probably we are one amongst few companies, which has not raised capital in last 2.5, 3 years, especially after COVID. In last 2 years, we've not raised capital. So we thought we'll raise some capital, small amount, and basically it will be future ready for growth, since we want to grow at 18-20%. Even though our car is comfortable, our DER also is pretty comfortable. We thought we'll have some cushion on the DER so that we can grow, at a much faster pace.
Okay, okay. Thanks a lot, sir, for answering all questions. I'll join back.
So next is Manan Tijoriwala. Can you unmute your line, Manan?
To understand, how do we avoid competition with the promoter entity which is also offering home loans? So is the target audience different there, because we've reduced our spread as compared to banks? So how do we deal with that?
No, we have so many banks. We have so many banks with whom we are competing. We have SBI, we have Bank of India. I mean, all private sector banks, all PSU banks, all the HFCs. We compete with all. So there is some overlap, in some segments. I think that is part of this market, and we have to live with that. So we have, in fact, all the banks, they do compete with us at least, in certain segments, in certain geographies. So I think that is not really, impacted at all, at least in last 4 quarters, because we have a niche segment. We work on geography strategy, and we have the first more advantage. We give doorstep service. We give advisory on legal and technical. Our TATs are one of the best in this space. So we have all these USP to try and gain market share.
Got it. And sir, any guidance on how the ticket sizes should move?
Ticket size will be in that range only. It will not go up drastically. Now it's about 21 lakhs, or 21, 22. It will be in that range only.
Right. And sir, is there any effect from the LCR guidelines going forward? Because I mean, do we have some solutions to counter the effect of these guidelines on account of the CPs that we hold on the book?
Not at all, because today on LCR we are holding significantly higher amount than what is required, and we have a positive carry, so it's a positive impact on LCR investments.
And so do the bank lines that we have qualify for liquid assets or something like that?
No. No. So whatever we LCR we maintain, we cannot take into consideration the undrawn limit. It is purely on the investment what we done. Today we are holding 103% of what LCR requirement is required. That I'm talking about the March 22. What we have to take 103% against the requirement of 50%. So we invested everything in the GSEC with the positive carry.
Got it. So that's all from my side. Thank you.
Thank you.
So one of the clients wanted to know, sir, that we are currently at 23-24% on NHB borrowings. Do we have any further room to take that up further? And also, if we can share what is the blended stream-wise cost of funds for us?
No, we don't actually plan. We only, build the book and have a pool which can be refinanced under various schemes of National Housing Bank, right? So now what you see as 24%, I think going forward it might slightly come down because of the denominator effect, because we are growing, right? Earlier we used to get about 1,500 crores as refinance from NHB, and now that amount is 2,000. Unless they increase the allocation, I don't think so this number will go up. If they increase, this number will be almost in that range. Otherwise, this will come down because of the denominator effect. And the blended cost from NHB is under 5%.
Okay, and what would be our blended cost on NCDs and bank borrowings?
Bank borrowings for last quarter, it was about 5.8687. And yeah, of course, the NCDs we had raised long back. I think if you look at the cost, what we have raised, that's about 6.6, 6.7 in that range.
Sure, sir. So Sanjeev sir, any thing that you want to ask?
Yeah, actually, sir, coming to the uh, equity raise part of it, which is so you've obviously, as one of the participants also asked, that you are currently at your desired ROE. Where do you think you would let ROE go down to, or like so that you're okay? As you said, you want that comfort also of having the funds. So, is there a thought there, and also anything on the dividend policy?
On the capital raise, in fact, we've been saying since last, I think, little over 2 years that we will raise, but we haven't raised.
Yeah.
We didn't raise because we didn't feel that there was a need. Right. Even now, if you look at both CAR and DER, I think it's not required today.
Yeah.
Since we want to grow, we thought we'll raise some capital because we are one out of the few companies which has not raised capital in last 2 to 3 years time, and therefore we thought we'll raise very little capital. I think on the ratios, I'll leave it to you, but I don't think so. It will have any significant impact because we are also growing. Our PAT will increase, and therefore you will have enough cushion to look at all those ratios.
Sure. But is there any quantum that like beyond which you'll not raise, or I know it's difficult to say, but anything,
We have enabling approval for 1,000 crores.
Right.
So initially we might just go for part of that amount. We haven't still decided, but we'll go in for part of that 1,000 crores.
Right. Sure.
And in fact, a lot of investors, in last few quarters, they have asked as to why we are not raising capital. So we get both the
right.
Yeah. Yeah.
In a way, true. As someone was pointing out, your valuations are pretty low, although still, you're still much above book. So raising capital at least doesn't dilute that part. So that's the good part. Yeah. Sure. So anything that else that we should, from a strategy perspective going forward, anything that you're looking at that you want people to be aware of?
I think we've been sharing, in all the investor calls, in all calls like this, which is with interaction with a particular group or maybe on a one-on-one with individuals or investors, and also on media. I think we have shared all a strategy, what we're going to do in next few years, what is our thought on the outlook on growth with respect to disbursements and book, NPA, whether it's liquidity or asset quality. I think everything we have shared. There is nothing which we feel that we need to share because everything is shared. And if you have any questions, more than happy to address all your
Yeah. No, so Sanket, I am done because sir, as you said, you've been pretty transparent. Most of your calls, if anybody hears your earnings call or watches your TV interview, you've been there. So just so that's pretty clear. Sanket, anything from your side? Otherwise, I guess if nobody else has any questions, so we can.
So yeah, maybe the summary of the call was the one line that sir highlighted, that it's gonna be a dream run for HFCs next 3-4 years, and we can't wait more to see that, sir. Thanks a lot, sir, for taking up time again and answering all the queries that we had. Thank you so much.
Thank you very much. Thank you.
Thank you.